Exclusive, and that's from the house of BoFA ML. Sanjay Mookim joins us now. Sanjay, good morning. Thank you for joining us. I'm sure you must have enjoyed our Lynch interview as much as Aisha and Tanveer and me enjoyed it. But just to take a leap forward from what we got from the management of L&T, he's sounding confident about business. If L&T is sounding confident about business, that means cyclical demand and industrial demand in the economy is coming back. Do you think this time it is genuinely different, or we could be in for a year of great expectations, high expectations, and then we'll meet with disappointment by the time year ends?
Good morning, a pleasure to be on. We do not think that the Capex cycle in India is recovering. There is a couple of reasons that people have gotten excited about it. One is that the investments data in GDP numbers, which is GFCF, which is part of GDP, it comes out every quarter. The last quarter number indicates a very strong YOY growth. So that is something that seems to have been picked up by the market. Unfortunately, this is a very, very base effect in this number, as with almost everything in India. If you look at the same series, data series with a 2-year CAGR and smoothen out the base effects of the GST, there is in fact no acceleration in top-down data, at least from a Capex perspective. Secondly, bottom up, the order flow for industrial companies in India has been strong in the first half. Our argument is that is largely because of a bunching up of full year order flows early in the year. And we've actually done a lot of analysis on this, and we argue that the second half order flow is likely to be weaker than people expect. And this phenomenon will probably continue into the next couple of quarters as well. And this is largely because many government agencies, which have been the significant drivers of Capex, are now clearly focusing on execution of orders that have already been given out, rather than on giving out additional new orders to these companies. So our sense is that the market is looking and grappling for new ideas. It's a tough environment really, and therefore there is a focus on talking about industrial recovery and a cyclical recovery. We do not think that the data supports that conclusion.
When you say that you don't expect order book to pick up, is it largely because you expect that there would be an election cycle, and because of election cycle the orders will get delayed, especially from the government side, or this is purely based on your demand supply scenario and that has not got to do anything with the election cycle?
So our analysis, and we did some work on this recently, is that elections do not seem to materially matter to the amount of orders that are given out in the economy. In the last several elections, we can't find any correlation to order flow in any case. In addition, what is happening now is that states in total have become far bigger than the central government. While they were a fraction of total central government spending, let's say 10 years ago, they are now 140 to 150% of total central government spending. So even if you have central government elections, that should not interfere with whatever Capex states are having. So no, we do not think there is an election-led cycle in Capex. We just don't think that industrial utilizations in India are high enough today to command a broad-based recovery in spending.
Right. And so then, Sanjay, how are you, discussing with clients about what the events lined up, the macro events lined up for 2019 would mean for the markets?
Well, morning. Look, the first half looks, from a macro perspective, looks actually pretty benign. We will see, we are already seeing, in fact, loosening of monetary policy in India. There is more liquidity injection. The RBI has talked about its OMO calendar for now. Bond yields have come off, and as the liquidity starts coming in, you should see lower interest rates in the market as well. That in itself is a decent stimulus for the economy. Lower oil prices, of course, have been much talked about, but they matter. There is strong correlation between corporate margins and falling oil prices. If companies pass on their cost savings to customers, there should be volume growth for companies as well. So from that end, the macro looks fine. There is a lot of expectation of a major fiscal stimulus into election. We are a little careful in baking that in because we don't think there's much time left. With the electoral code of conduct coming into play, let's say a month or so before the election, there's not much time left to actually transfer too much money to the bottom end of the pyramid in India. So maybe that rules out a major stimulus, but anyway the government's done enough for rural India and that demand should continue. So from a macro perspective, India seems to be in a pretty decent place, which is why there's been some recovery. I mean, India has outperformed EM almost 10% from October when oil started to fall. And that makes sense. Our argument is that while the market is focused on the earnings support from a lower oil price, the valuation disconnect between India and the rest of the world is pretty high. And as global central banks continue to withdraw liquidity, we are seeing the intended effects. We are seeing volatility go up. We are seeing risk, cost of capital go up. And so India is susceptible more from a multiples and valuations perspective than it is from an earnings perspective right now.
Sanjay, hi, morning. Less than a fortnight from now, we'll have another event, the budget. While it may not be a full-blown version, it being that close to elections, but do you think this could turn out to be a market-moving event? And if that were to be the case, what are your broad expectations from the budget this time?
Well, again, let me go back, morning, to my earlier comment is that, look, the central government has become a smaller component of total government spending in the country in any case, right? So if the government were to make some measures, let's say announce tax cuts for the middle class, there is a lot of media expectation around that. It could affect some of the consumer stocks in India. In fact, as a broad theme, whatever the government does in this budget is likely going to be consumer focused, getting into elections rather than a capex heavy cycle. That's not electorally conducive at the moment. But it remains to be seen how much the government has room and intention to do any of that in this budget.
Right.
Okay.
So the general view in the market is that we are in for a agrarian package for farmers and for rural income. If that is true, there would be a compromise on fiscal deficit. There would be a compromise on the expenditure front. So what will make markets happy? If you frankly ask markets right now, we are unhappy because the rural economy is under stress. But if the rural economy is getting fixed and that will come at a cost, will that make markets happy or unhappy because there would be a fiscal mismatch there?
So there's no such thing as a free lunch, right? It's a very old adage. So if the government were to be fiscally expansive, then the benefits of a looser monetary policy will be negated, because then the interest rates in the market will probably not go down as much as you'd expect. Okay, so you've got to choose. So if the government should spend, ideally only if it can find the resources to spend. And that's why the market is very focused on what the Jalan committee does on the RBI reserves. If it is able to transfer money to government which can then be spent, then it may not cancel out the effects of a easier monetary policy. But again, that committee is likely to take time. It's likely to recommend some action maybe later this month. And that's why by my earlier comment that there may not be enough time to announce and then actually distribute 1-2 lakh crores over the next 2 months.
I have to ask you the one question that's on everybody's mind, and that's essentially about how this budget could allay concerns on managing the fisc going forward. I don't know how much can they do that in one policy statement, but there is a sense, there's a kind of an obsession that the market has with the fiscal deficit number and the projection on growth. What's your take on that?
Look, this is currently a period of greater uncertainty on the deficit, simply because government's revenues on the GST have not improved as much as expected. That could partly be attributed to the GST tax rate cuts that the government has effected over the last 2 or 3 cycles. Now, assuming that no further tax rate cuts happen, there should be buoyancy to GST revenues. And maybe the government is therefore able to forecast an improvement on the collection side for next year and still hope for mid 3% fiscal deficit in FY 2021 and thereafter. So there is a reasonable case to make that the government could claw back some of the losses it has on the income side going forward. This again is contingent on how much you're taking in for disinvestment. So like I said, there's a lot of volatility in these numbers. My sense is that the government would not want to have, at least on a forecast, a significant breach to begin with of deficits, and maybe they'll want to contain it sub 4% for FY 2021 as well.
Do you think markets, and especially foreign investors, are no longer obsessed with fiscal deficit number? Because if you look at the fiscal deficit positioning, the US is completely out of whack. the fiscal deficit of American economy, or the so-called deficit of American economy, is completely uneven. We don't know which way China is headed. Japan is still printing money. So for when investors, they cry foul about India's fiscal mismanagement, and rating agencies are obsessed with whether it is 3.2 or 3.6, 3.6 is bad news, 3.2 is great news. You think there is a significant leeway which now institutional investors are adopting in their model portfolios when it comes to ascribing importance to fiscal deficit?
Well, it depends upon which investors you're talking to. If you're talking to equity investors, some of them may not be as concerned, like you say. But if you're talking to debt investors and bond investors, they are obsessed by the number, as they probably should be, because the fiscal deficit determines the demand and supply of bonds in the country. So if the government were to expand, let's say, deficit by 30 basis point or 40 basis point, there is therefore a significant increase in the supply of bonds, and therefore the prices of bonds would fall. Okay, and indirectly that matters to the equity market, because the bond investors were to take bond yields higher and interest rates in the economy go up, that will affect ultimately consumption and equities with a lag. Right? So we should be worried about what a fiscal deficit is and what levels are manageable, but the more direct consequence is actually in the bond market rather than in the equity market.
Sanjay, do you not think that RBI's possible large dividend may just help bridge that fiscal deficit gap, although it is just going to be a one-time adjustment?
Well, some bridging is necessary, because the government, at least in FY19, is significantly behind on its collections. Our estimates are that the GST collections or gross basis are at least 1 lakh crore behind where they should be. The disinvestment, even if the government gets the new tranches out, will be behind by 30,000 crores. There's some other slippages on revenue. So even if the government is able to keep expenditure in line with where they forecast, they need some one-time additional revenue source just to keep the revenue misses intact. And it may not create additional ammunition for government to spend beyond.
I'm sure that this has been the top talking point, in conversations with your clients about how does one look at the election risk in India. What are you telling them?
Well, look, there are two ways to answer this. Elections may or may not impact the business cycle. In fact, we are going to lean towards saying that elections increasingly do not matter to the economy and the way the business cycle in the country recovers. Again, I'm repeating third time on this interview that the central government is becoming a smaller portion of the total country's economy. However, elections may matter to the market sentiment. And I think the market looks for stability, the market looks for a government that will possibly last 5 years. And if you get an outcome where the market is worried that is not going to happen, so let's say there's a coalition in power which is shaky from day one, then it will hurt sentiment. It will probably lead to downside in the market, and that is an event that a lot of investors are starting to look at. It's very, very common in conversations nowadays.
It is. What is also common in conversations, Sanjay, given to understand, is all that talk about a rate cut and a complete U-turn in monetary policy stance within a matter of, I think, a few months, 5-6 months at last count. And what would that do to infuse confidence in the business cycle, like you said, as also, shore up the numbers and growth?
So look, conceptually a high real rate environment does hurt investment. Obviously it improves savings, but we do need probably accelerated investments in the economy. Today there is headroom for RBI because inflation numbers have been below expectations. This should probably come back, and you could see inflation get into the high 4s, 5s towards the later part of calendar 19, but at least for now there is some room for RBI to cut rates. More so, I would point again to the fact that the RBI is injecting liquidity, buying bonds. This brings down yields in the market and reduces interest rates for borrowers. It not only improves corporate profit through lower interest costs, but it's actually more demand stimulative. The impact of stimulating demand through lower interest rates probably can be more powerful than just the direct implications of a lower interest rates in the economy.
Sanjay, do you think this budget will throw in opportunity of any sector-related trades? I mean, typically you know that tobacco taxation is something that, you know, the talks around it get heightened typically around every budget. Do you think there are any such trades that one needs to look out for?
See, there can always be events, such as the ones you mentioned, such as, you know, income tax reductions and so on. But I don't think that this budget is going to directionally change the way the market's headed, whether up or down. It's very unlikely to be a trend reversal because of what's happening in the budget.
On a broad basis, Sanjay, as I go through your note, you're advising buying bonds versus equities. Is that your preferred trade for the year, or is it more subject to the volatility that may come by because of these macro events, because of the budget, because of the elections?
Well, that was some time ago. Bond yields already have come off quite a bit. Okay, we are careful on Indian equities because the valuation disparities are pretty high. If you take the top 10 percentile of stocks in the country, the bottom 10 percentile, the difference in price to earning multiples of these two sets continues to rise. It's at all-time highs and still going up, while the difference in growth of the top 10 and the bottom 10 is actually falling, and it's close to lows. So now what's happening clearly is a herding of investors in a certain bunch of stocks. The high PE stocks continue to re-rate, you know, which is not happening elsewhere in the world. Earnings expectations are too high. The Nifty is forecast to deliver 24% next year, but 70% of that comes from 4 stocks, right? Mostly the banks. So there's a very concentrated hope for the earnings recovery. Expectations remain too high, and globally cost of capital is going up. India benefited when cost of capital was going down. Our stocks re-rated. A lot of value has been accrued through the multiple expansion in India. This is a significant risk unless globally the liquidity direction reverses. Today, central banks are withdrawing liquidity in aggregate, and that's going to hurt asset prices everywhere.
Argue that, and again, I'm just being a devil's advocate here. What surprised me in 2018 was volatility and the persistence of domestic institutional investors. Do you think somewhere in 2019 what could surprise us on the liquidity front is that central banks may not hike, India may reduce rates, and the liquidity which right now we think is under cloud because of central bank tightening may not be that tight. So if liquidity is benign, both locally and globally, what happens to the markets?
Well, if let's say some central bank flips, let's say the Fed turns around and say the balance sheet reduction has stopped, and in fact we are starting QE again rather than doing QT, you just turn around and say, look, this is inflationary for asset prices. And the one lesson we've learned from the last 7 years is to not to fight the central bank. If there is liquidity injection, all asset prices go up. If there's not, it starts coming off. The correlations are almost close to 100%. So if that happens, you will go out and say, yes, turn around, buy equities, buy risk assets, buy emerging market. But the moment that's not, even if the Fed turns around and says that we are reducing the number of rate increases for the year, or at least the market believes that way, we're still on a path to withdraw $50 billion a month. And it's a significant amount of liquidity withdrawal, which should hurt, and it is hurting. Real estate prices are falling in most major markets. You're seeing bond yields going up, you're seeing volatility spike, and equity valuations are being hurt as well. So unless that changes, I don't see how valuations, expensive as they are sustainable.
Very simply, I remember in 2018 you were part of the minority camp when you said that we will not make returns. For 2019, are you making a case that we could be in for no returns or maybe negative returns?
Well, we're not saying negative now. 2018 we did have a negative return forecast. For 19 we are hoping we'll have a flattish year, but with higher volatility through the year. And again, this is a consequence of the fact that there's lower liquidity, lower asset price support in globally actually. But fingers crossed, we are hoping that the major stocks in the country are in fact able to deliver profit growth, and that should provide some sort of support to Nifty index level. So we're looking at mid-single digit return to December for 2019.
18 again was a flat return for Nifty, but you had a TCS and a Reliance which did exceptionally well. So when you say that we are in for flat returns, I'm assuming that you are referring to the benchmark indices. But even if it's a good year, there would be a group of stocks within the Nifty which will give you 20 to 30% return. There would be, even if it's a great year, there would be some stocks which will give you 20 to 30% negative return. So how would you categorize that?
Well, that is always true. In fact, even a falling market, you'll have some stocks which are going up, right? Now, you may have a smaller set when the market itself is going down, and a bigger set of stocks that do well when the market is going up. Even in this year, there should be some stocks. I don't know if I knew which beforehand, I wouldn't be sitting here talking to you. Sorry, but look, that's the job of all of us sitting in the market to figure out which those 5 stocks, 6 stocks are, which are going to make me 20% for the year. We believe we know which ones these are, but we'll find out for sure later. We think that financials look well placed, and we also pitch in favor of the rural oriented stocks in the year, not because we think the stimulus is coming, but we think the demand is already pretty okay.
Okay, on that positive note, Sanjay, we let you go. Glad that you could take time out and join us today.
My pleasure.